Two founders, same revenue, same country. One pays close to 40% in taxes every year and carries all the risk inside a single entity. The other keeps significantly more of what they earn and has their profits protected and separated. No offshore move, no aggressive loopholes, just structure. And here is the problem. Most entrepreneurs never set this up, not because it is illegal, but because their accountant never explained it or does not fully understand it themselves. In this video, I will show you exactly how to use a holding structure to reduce your tax exposure and protect your assets. We will cover how it actually works, what it protects you from and what does not, and when this is enough versus when you need to go further internationally. By the end, you will know whether this is something you should implement immediately or whether your situation requires a different approach. I have spent the last nearly 9 years working with entrepreneurs across Europe to structure the businesses in a way that reduces tax exposure and protects retained earnings without adding unnecessary complexity. In that time, I've worked with hundreds of clients across 9 countries, and the pattern is always the same. The entrepreneurs who build real lasting wealth are the ones who get the structure right early. Let's start. First, let's simplify what a holding structure actually is, because most explanations overcomplicate this. At its core, a holding structure means you split your business into 2 layers. You have your operating company. This is where revenue comes in, clients are served, and the day-to-day activity happens. And then you have a holding company, which owns the operating company. That's it. But this simple separation is one of the most efficient ways to protect business assets. And most entrepreneurs are not using it. Here's what this looks like in practice. Your operating company generates profit. Instead of leaving that profit sitting there, fully exposed, you move it up to a holding company. Now, the key idea here is separation, because your operating company is where all the risk lives. Client disputes, liabilities, operational issues, everything happens there. But once profits are moved to the holding company, they are no longer sitting inside the risk environment. So instead of building wealth inside the same entity that carries risk, you are extracting it and protecting it systematically. Think of it this way. Your operating company is the engine. Your holding company is the vault. The engine runs the business. The vault holds what it builds. That separation is the entire foundation of this strategy. Now, this is where most people get this wrong. A holding structure protects you from business level risk. If something goes wrong inside your operating company, a legal dispute, a creditor claim, a liability, the assets sitting in the holding company are generally insulated from that. But it is not a blank shield. And I want to be direct about this. It does not protect you from personal guarantees. If you have personally guaranteed a loan, the holding structure does not change that. It does not protect you from compliance failures or fraud. Courts can pierce the structure if it was set up to deceive. And it does not work if it's set up incorrectly. A holding company that exists on paper but is not operationally maintained offers very limited protection. This is why just having a holding company is not enough. The structure, the movement of money, the documentation, those are what actually make it effective. Done properly, it works. Done carelessly, it is a false sense of security. So, when is a domestic holding structure actually sufficient? For a significant portion of business owners, this is the most important first step. If you are operating primarily in one country, generating consistent profits, and your main goal is to reduce exposure while building retained earnings, this structure alone can solve a large part of the problem. But there is a threshold where this stops being sufficient. If you are operating in a very high tax environment and your retained earnings are growing significantly, if your revenue is becoming more international and your banking exposure is concentrated in one place, or if the regulatory environment in your country is shifting in ways that create new risks, then you likely need to go beyond a domestic holding structure. But stop. Here is the mistake I see most often. Entrepreneurs jump into complex international setups before they have the domestic foundation in place. They spend money on offshore structures that sit on top of an unstable base. In almost every case, the holding structure is the foundation, and skipping it creates more problems than it solves. Let's get specific. Here's how this is actually implemented. Step 1. You create the holding entity. This is a clean company whose sole function is to own shares in other entities. Nothing else happens inside it. Step 2. You restructure ownership. Instead of you personally owning your operating company, the holding company owns it. You own the holding company. The holding company owns everything below it. Step 3. You align your banking and compliance. This is where many setups break down. The structure exists legally, but the bank accounts, the payment flows, and the compliance documentation have not caught up. A structure that is not operationally clean is a structure that will not hold up under scrutiny. Step 4. You define how money moves. Profits are distributed intentionally, typically through dividends or structured intercompany transfers. The operating company only holds what it needs to function. Everything above that moves up. Step 5. You document everything. Board resolutions, transfer documentation, intercompany agreements. Without proper documentation, even a well-designed structure can be challenged. None of this is complicated, but every step requires precision. The entrepreneurs who do this well are not doing anything exotic. They are just doing the fundamentals correctly. We worked with a production company based in Austria who was generating 28 million euros annually. Everything was running through one single entity. All retained earnings, operational cash flow, and strategic reserves were sitting inside the same company that carried supplier risk, contractual risk, and day-to-day production liability. The trigger was a succession plan. We restructured into a 2-layer holding setup. Now, the operating entity only holds 6 months of working capital. Everything above that has been moved up and protected. Same business, same revenue. Completely different risk profile. And in the following months, when succession planning, ownership transition, and liability questions became immediate, the retained earnings were untouched. That is what this structure is designed to do. Most entrepreneurs who need this structure set it up too late, after a liquidity event, after a regulatory change they did not see coming. The holding structure is not a complex strategy. It is the foundation. And the best time to build a foundation is before you need it, not after something has already gone wrong. If you have been running everything through a single entity, this is the video to act on. If you want clarity on whether a domestic holding structure is enough for your specific situation or whether you need to go further internationally, you can book a free Compass call using the link in the description. On that call, we will look at your current setup, your jurisdiction, your retained earnings, and give you a clear answer on what the right next step is. The link is below. See you in the next one.